Good day, everyone. Thank you for joining us once again here at Seafried and Brew for our economic briefing. I am Jamie Sumner, the chief analyst, and for this week's briefing, we want to finish out the year looking at the inflation number, doing a little recap in terms of where we've seen the retail sales over this last quarter of the year, and look at the 10-year Treasury, see how that has changed throughout the year, and then come back and finish off with that Fed fund probability in terms of where the market is seeing the Fed funds over the next year. So when you look at that inflation number at CPI, you can see there hasn't been as much inflation as maybe the Fed would have predicted in the beginning of the year. In fact, when we look at it on a historical standpoint, for November, the year-over-year change, 2.2%. And we look prior to 2008, that Great Recession, that average was 3.1%. So we still see this subdued inflation numbers coming through in terms of the consumer price index. This red line being where we are in November, and the green line is the average prior to 2008. And we follow that up with the overall level of retail sales that we've seen. And year over year for November, we were up 4.2%, fairly strong, come down from our high of close to 6.5%, a little over 6.5% earlier in the year. But we still see this stronger retail sales number. So this will help us with those GDP for the fourth quarter. Hopefully, December numbers will come out similarly, and we will have a strong retail sales or consumer segment for the fourth quarter. Month over month for retail sales, up 0.2%. The consensus was 0.1%, so a little stronger than consensus. In terms of that 10-year Treasury, we've had a fairly wild year. We reached our low all the way back at the beginning of the year at 244. Our high happened in November on the 8th when we reached 3.24. So we had a pretty good run up, and then we came back down this morning looking at a 2.84% on that 10-year. So we continue to see that slope of the yield curve narrow as we see the 10-year Treasury come back down. And this is about where we anticipate it to stay. I would say over the next year, I still say this, we'll see some volatility, but I think we're going to continue to come down to that sub 3% number on that 10-year, somewhere between 2.85 and 3%. When we got up to that 3.24, I stood behind the fact that I believe is going to still come down below that 3%, just because the global economy and where we see the GDP for the globe and the projected GDPs kind of doesn't support such a high 10-year Treasury. With that said, we look at the Fed funds rate. It's Fed week. Tomorrow on the 19th, we get their statement, so we'll see what they're going to say. Most likely, and the probabilities are that we will see another Fed increase this week. However, according to these probabilities, and this has changed over the past couple of weeks here, we're showing that after this one increase this month, we don't see any more for the remainder of the year. So that's 2019 showing no interest rate hikes in terms of those Fed fund numbers. It's a pretty big deviation from where we were just a couple of weeks ago. But we'll see what the Fed comes out with their new dot plot and their projections. See if they're still suggesting 3 more rate hikes next year, or if they're going to pull that off a little bit. and show only 1 or 2. But for the Fed funds implied probabilities, it's looking like we have tomorrow's rate hike and then holding off for a fair amount of time until we see another one. So this would be more of a dovish sign. Well, that's what we have for you today. We look forward to speaking to you in 2019. So everyone, have a Merry Christmas and a Happy New Year.